Jake puts all his spending on a rewards credit card. Marcus puts all his spending on a debit card. They both think they made the smarter choice. They're both wrong because one of them is leaving thousands of dollars on the table without realizing it, and the other one is carrying more risk than he thinks. And when you actually run the numbers, the gap will surprise you. Let's keep this fair. Jake and Marcus both earn $55,000 a year. They both spend roughly $2,800 a month on everyday purchases, groceries, gas, subscriptions, dinners out, same income, same spending habits, same city. The only difference is the piece of plastic they hand the cashier. Jake uses a cashback rewards credit card and pays the full statement balance every single month, no exceptions. Marcus uses his debit card for everything and never carries any debt at all. On the surface, it looks like Marcus is the responsible one and Jake is playing with fire. On day one, Marcus feels like the adult in the room. No debt, no risk, no chance of a spiral. His co-workers warn him about credit card people who overspend and drown in interest. Jake, meanwhile, gets a welcome bonus on his new card, $200 after spending $500 in the first 3 months, something he was going to spend anyway. He also starts earning 2% cash back on groceries and gas, and 1% on everything else. His friends ask what card he's using. Marcus's friends don't ask him anything because there's nothing to ask about a debit card. It's not even close in terms of how it feels. Jake looks like he's gaming the system. Marcus looks like he's playing it safe. But feelings and math are two very different things. Here's something most people don't know. A well-known study from MIT researchers found that people are willing to spend significantly more in some experiments, close to double when paying with a credit card instead of cash, because swiping doesn't feel like spending the same way handing over bills does. That's a real psychological effect, and it's the entire reason debit cards exist as a discipline tool. But Jake isn't impulsive. He spends exactly what he was already spending and pays it off in full. So that risk, for him specifically, isn't actually in play yet. Keep that in mind because it matters later. By the end of year one, Jake has earned roughly $620 in cashback and bonuses on his $33,600 in annual spending. He paid $0 in interest because he never carried a balance. Marcus has earned exactly $0 because debit cards almost never offer meaningful rewards. Some debit cards offer small perks, but most major banks dropped debit rewards programs years ago after regulations capped the fees banks could charge merchants on debit transactions. Marcus didn't lose money, he just never had the chance to make any. Now here's the part nobody talks about at the dinner table: fraud protection. In year two, both Jake and Marcus get caught in the same data breach from a retailer they both shopped at. Someone makes $1,400 in fraudulent charges on each of their accounts overnight. Jake calls his credit card company. Under federal law, his maximum liability for unauthorized charges is $50. And in practice, every major card issuer waives that completely. His provisional credit hits his account within 24 hours. He never sees the money missing from his life. Marcus calls his bank. Debit cards fall under a different federal rule, Regulation E, and the protection depends entirely on timing. Report it within 2 business days, you're capped at $50. Wait longer than that, even by accident, and your liability can jump to $500. Wait past 60 days from the statement, and you can be on the hook for the entire amount. Marcus catches it on day 4 because he was traveling. His liability cap just jumped to $500. And worse, that $1,400 was pulled directly out of his checking account, the same account he pays rent from. For 9 days while the bank investigates, Marcus is short on real cash sitting in his real bank account. Jake never lost access to a single dollar. The card everyone assumed was safer turned out to carry more real-world risk. Let's check the scoreboard by year 3. Jake has earned just over $1,900 in cumulative rewards. He's also been building something Marcus hasn't touched at all: credit history. Every on-time payment, every low utilization month is reported to the credit bureaus. Marcus's debit card activity reports to nobody. It doesn't build credit because there's no credit involved. It's just moving his own money around. This becomes very real in year 5, when both Jake and Marcus apply for mortgages on identical $300,000 homes. Jake's years of responsible credit use have pushed his score into the high 700s. Marcus, who never touched credit, has a thin file and lands in the high 600s. The bank offers Jake a rate around 6.5%. Marcus, with a thinner profile, gets offered something closer to 7%. That half a point gap spread across a 30-year mortgage works out to roughly $36,000 in extra interest over the life of the loan. Marcus didn't do anything wrong. He just never built the one financial record that lenders actually look at. This is where the story fully flips. The card that looked dangerous turned out to be the one quietly building Jake's financial life in the background. The card that looked safe turned out to be financially invisible. By year 10, Jake has earned close to $6,200 in lifetime rewards, paid $0 in interest, and is sitting on a stronger credit profile that will save him money on every future loan, every car purchase, possibly even some insurance premiums, since several states allow credit-based insurance scoring. Marcus has saved the exact same amount of cash, spent the exact same amount of money, and has nothing extra to show for it except a checking account that never grew debt and never grew rewards either. If I only showed you the upside of credit cards, I'd be lying to you. The entire result above depends on one non-negotiable condition: paying the statement balance in full every month, without exception. The moment that stops being true, everything reverses violently. The average credit card today carries an interest rate around 24%. If Jake had carried just $2,000 on that same card instead of paying it off, he'd owe roughly $480 a year in interest alone, instantly wiping out his rewards and then some. Credit card debt is also the easiest debt in America to slide into because the minimum payment is designed to keep you paying for years. A $3,000 balance at 24% interest, paying only the minimum, can take over a decade to pay off and cost more than double the original amount in interest. That's not a hypothetical. That's the actual structure of revolving credit, and it's why the average American household carrying a balance owes thousands of dollars they never planned on owing. This is exactly where debit cards win, and win clearly. If you know you struggle with impulse spending, if you've carried a balance before, or if you simply don't want the temptations sitting in your wallet, a debit card removes the entire risk equation. You cannot spend money you don't have. There's no interest, no debt spiral, no minimum payment trap. For some people, the psychological safety of debit is worth more than any rewards program, because the math only works for Jake if Jake actually has the discipline he claims to have. Plenty of people don't, and pretending otherwise is how people end up worse off than Marcus, not better. Jake and Marcus both walked away thinking they'd made the responsible choice. Jake thought rewards were free money. Marcus thought avoiding credit meant avoiding risk. Neither of them ran the actual numbers on what their choice was quietly building or quietly costing over a decade. The real trap isn't the credit card, and it isn't the debit card. The real trap is assuming the safer feeling choice is automatically the cheaper one, without ever checking what it's doing to your credit file, your fraud protection, or the thousands of dollars sitting in rewards you never collected. So the next time someone tells you debit is always safer or credit is always smarter, ask them one question. Did you run it past month 1? Because that's the only answer that actually counts.